When institutional managers run diverse investment strategies, say global macro, distressed credit, and systematic quant, under a single corporate umbrella, they face a strict operational challenge. If a catastrophic loss hits one strategy, it threatens the liquidity of the entire platform. The default setup is the standard multi-class fund. In this model, different investor groups hold different share classes, but those classes are ultimately tied to a single, shared corporate balance sheet. Managers try to isolate these strategies using what is known as notional separation. They rely on internal accounting ledgers and contractual promises in the offering documents to keep the capital pools apart. The vulnerability becomes obvious during a severe insolvency event. If the distressed credit strategy fails, its creditors won't stop at the boundaries drawn by internal spreadsheets. They will seek to recover their losses from any available capital within the entity. Under real legal stress, those contractual firewalls often collapse. An aggressive creditor can pierce the notional separation, dragging the assets of healthy share classes into the bankruptcy proceedings of the failed strategy. Internal accounting offers zero absolute protection against real-world legal claims. True downside protection requires a mechanism that guarantees strict structural isolation. The legal mechanism designed to address this contagion problem is the Cayman Islands Segregated Portfolio Company, or SPC. The defining feature of an SPC is statutory ring fencing. A single legal entity creates multiple distinct subfunds, known as segregated portfolios. If segregated portfolio A becomes insolvent, its creditors are unequivocally blocked from pursuing the assets of segregated portfolio B. The liabilities are isolated. This separation is not a contractual promise, it is a statutory right enshrined in Cayman law. It overrides standard legal agreements and holds up in insolvency court. The structure also includes a general account. This is a separate ledger holding shared, entity-level assets and liabilities, like the platform's incorporation costs, that sit completely independent of the specific investment strategies. The SPC structure creates a vault-like environment within a single legal entity, provided the accounting framework is executed flawlessly. The golden rule of the SPC is absolute segregation. Any cross-contamination of assets between portfolios is illegal and constitutes a direct breach of the director's fiduciary duties. Fund accountants must maintain completely separate general ledgers, establish distinct custody accounts, and distinct bank accounts for every single segregated portfolio. When an investor subscribes, their capital must be wired directly into that specific portfolio's designated bank account. Zero temporary commingling is allowed, not even for a day. Operational costs follow strict boundaries as well. Shared entity-level expenses, like the annual regulatory fee or an audit cost, cannot simply be absorbed by whichever portfolio has the most cash. Administrators must use a documented expense allocation methodology. They might split a fee equally among the portfolios or charge them proportionally based on their net asset value, but the math must be consistent and transparent. This rigor extends to investor capital movements. Occasionally, an investor will want to switch their capital from Portfolio 1 to Portfolio 2. This intra-SPC switch cannot be executed as a simple internal book entry. It requires a hard redemption from the first portfolio, an actual cash wire transfer between the two bank accounts, and a brand new subscription into the second portfolio. The legal firewall holds up in court only because the daily accounting reality perfectly mirrors the statutory separation. To see this defense mechanism in action, we look at XYZ SPC, a $60 million multi-strategy fund managed by 3 distinct investment teams. This table shows their opening positions on January 1, 2024. The capital is distributed across 3 segregated portfolios: SP Macro with $30 million, SP Credit with $20 million, and SP Quant with $10 million. All 3 portfolios begin the year with a clean $100 net asset value per share. At the platform level, the SPC general account holds $15,000, sitting entirely outside the 3 strategy silos. These 3 strategies share a corporate name and an administrative umbrella, but they are about to face vastly different economic realities. The stress test begins on January 15th. SP Credit receives a sudden wave of redemption requests from its investors totaling $12 million. That demand represents 60. To prevent a fire sale, the SPC board enacts an emergency liquidity gate exclusively on SP Credit, capping redemptions at 25% of its net asset value. As a result, only $5 million in cash is actually paid out to SP Credit's redeeming investors. The remaining $7 million in requested redemptions is recorded internally as a deferred redemption payable. This creates a massive liability, but that $7 million debt is strictly within SP Credit's specific ledger. Right next door, there is zero panic. During that exact same week, SP Macro smoothly receives $5 million in new investor subscriptions. The statutory ring fence empowers the board to aggressively freeze a single distress strategy without triggering a platform-wide liquidity run. The situation deteriorates further on February 28th. SP Credit's valuation committee is forced to drastically mark down an illiquid distressed bond position. The administrator must book a $2 million unrealized loss against the specific investment. That write-down is debited directly and exclusively against SP Credit's assets. The investors in SP Macro and SP Quant absorb absolutely none of this $2 million loss. They are completely shielded. Because every single security is unequivocally designated to a specific portfolio at the time of purchase, a catastrophic failure in one strategy cannot legally drain the performance of its sibling portfolios. By the end of the first quarter on March 31st, the efficacy of the structure is visible in the financial reporting. This data table reveals final closing NAVs. SP Credit's value plummeted from $100 to $80 per share, dragging a massive deferred liability. Yet in strict contrast, SP Macro and SP Quant grew independently, reaching $101 and $108 per share, completely insulated from the damage. The SPC absorbed a terminal blow to one strategy while allowing the others to thrive, a result impossible in a standard fund where every asset is legally available to creditors. This absolute isolation must survive the grueling scrutiny of an independent financial audit. Auditors actively test the structure, looking for cross-contamination, verifying shared expense allocations, and confirming strictly distinct bank accounts. They enforce the ultimate mathematical test of the platform. The sum of all individual portfolio NAVs plus the general account must equal the total platform NAV, with zero undocumented variance. They also assess the fund's operational health at the portfolio level. SP Credit's distress and liquidity gates do not bankrupt the wider platform or jeopardize the other strategies. Managers secure the cost efficiency and regulatory ease of a single corporate entity, while providing investors with the specific downside protection of multiple standalone funds. SPC relies on meticulous operational controls to turn abstract legal statutes into a functional barrier between distinct pools of capital.